for the day. Once again, I want to thank our distinguished panelists, Jesse Thompson, senior economist with the Federal Reserve Bank of Dallas, Chris Hosek, principal with the Texas Star Alliance, Tim Tarpley, senior vice president of affairs with the Energy Workforce and Technology Council, Deanna Duell, consulting director with BKD, last definitely not least, Marcella Burke, partner with King and Spalding. And so each speaker will briefly introduce themselves, and then we'll go into a hybrid PowerPoint and fireside discussion. Please, like I said, we want to make this interactive, so we all have smartphones and the internet. Feel free to Google, ask questions, right? So whilst you have them here, I myself find it very difficult actually getting in contact with some of these folks, and I'm working with them as well. So whilst you have them, in front of you, feel free to go ahead and ask your questions. And so without further ado, I'd like to introduce the senior business economist at the Houston branch of the Federal Reserve Bank of Dallas. Jesse joined the bank in 2010 and performs research and analysis on issues affecting Houston and the Gulf Coast economy. Jesse Thompson.
Good evening. All right, so I'm going to open up here. Let me share my screen with hit y'all with some charts. So really exciting way to kick off. I apologize, I got a couple things going on here, but really exciting way to kick off the evening. And are y'all looking at my slides now? Here we go.
Yes, we see your slides, Jesse.
Excellent. So I'm going to give y'all a quick sort of state of the industry, a bit of an update on the sector. And my goodness, there's just so very much to talk about. I don't know how many different slides I could put in here to talk about this, so I try to keep it very narrow. But there's just a lot of things to talk about. But before I do, a little bit of housekeeping. Of course, I need to always remind everyone that I work for the Fed, so my opinions are mine and mine alone, and not necessarily representative of the views of the Federal Reserve Board of Governors, bank presidents, officers, and anyone else associated with the Federal Reserve Bank in any way, shape, or form. And as we go through the slides, I'd like to remind you all that a lot of the feedback that we have in a lot of the content, a lot of the flesh on some of the data that I have here is comes out of feedback from real businesses out there. It's not just economic data and analysis. This is sort of my ask here for everyone in the audience. The Dallas Fed has a number of different surveys for manufacturing, for the service sector, and for the retail sector, and of course, the Dallas Fed Energy Survey. All of these surveys provide vital monthly real-time feedback from actual business leaders making decisions in real time, responding to real market incentives. And over the course of the last 2 years, I like to emphasize economic data has come with a lag. It is subject to a substantial amount of revision. And the financial data has been, there's been so many different shocks and things it's hard to keep track of. The survey data and the feedback, the commentary that we got from businesses and business leaders in our surveys played an outsized role in our monetary policy over the last years compared to normal years. So it's been vitally important. So if you feel like you have something to contribute, you would like to participate in our surveys, please, you can go to dallasfed.org, go to our website. There'll be a QR code at the end of the slide deck, which I will share, which you can use to link to our site to tell me how I did and also to sign up for all these things. I can't promise you'll get into the survey because we try to keep everything representative, as the survey sample as representative as possible of the state of Texas and its broader economy. But we really do want to hear from you. Just a quick taste of that's relevant for the discussion today for oil and gas is we asked all of our survey respondents something like this question, which is, when do you expect your supply chains to return to normal? And in fact, we've asked it every other month the last year. I've got 3 of them shown here. So supply chain challenges are likely to persist. And if you'll notice at the beginning of the survey period here, about in June 2021. So we're coming out of the pandemic. Everybody's feeling pretty good. Remember, this is before the Delta wave hit us of Omicron. Everyone, I would say the most people were pretty sanguine that, over the next 6 months, maybe sometime early next year, we're going to get back to normal. And as you can see, as you move forward through time, people became less and less optimistic. And when you look at the fact that 16% said not sure, a little over about 27% said more than a year, and another quarter said 10 to 12 months. I equate that with the vast majority of the respondents to our surveys don't know. That's a long enough in the future. That's just saying we don't really know when our supply chains are going to get back to normal. When is the price pressures that are associated with that going to get back to normal? And when you talk to the oil and gas sector, which I've been doing here, we've got this Beige Book report that we put out every 6 weeks. The Dallas Fed puts out the Beige Book, and most of the energy upstream oil and gas commentary in that comes from our district. Not all of it, but the majority of it. And what we're hearing is that everything has gotten worse. They've joined the supply chain woes of the rest of the economy now that they're trying to ramp up, and there's nothing to add. Everything is back ordered. You want to get some equipment for your rig. Well, guess what? It's going to take 6 to 10 months where it would have taken 3 to 4 months a year ago. And if you need anything more complicated than a component, you need an actual transmission or an engine or something, it's going to take a year. So supply chains have gotten very, very backlogged. There's no spare capacity to hire that and to in that supply chain to increase output. And so the industry, and that's not to say anything of the labor constraints. It's very hard to hire in the industry. So the sector is very constrained in terms of its capacity on the supply chain side and on the labor side to respond to recent market pressures. And that's going to be important when we talk a little bit about the oil and gas sector and in the United States and how it's responding to this environment that we're in right now. So first off, let me just say a quick summary. Fallout of Russia's invasion of Ukraine, lots of open question marks about what this means for the global economy, and I'll go into more detail. Global balances are expected to tighten further. By balances, what do I mean? I mean crude oil liquids. I mean the global inventories, the market is expected to tighten a lot further, but there's a lot of disagreement over exactly what that looks like on both the consumption side and the supply side. And our response is likely going to be limited due to, in quotation marks, capital discipline, rising input costs, and a very challenging labor market. I cannot tell you the number of firms who are saying, now small E&Ps, not just big publics, who are saying we would increase more than we currently are if we had the capacity, if we could get the orders, if we could hire the people. But there are a lot of companies, particularly larger public companies, who are touting the capital discipline line and say, well, actually, no, we really are going to focus on investor returns right now. Those are two sides of the same coin. Objectively, they wind up looking like the same thing, a slow and steady rig count. And so you're looking now at tightening fuel markets with production kind of being measured and in demand consumption still being fairly robust. The fuel market is tightening, and we're all seeing it at the pump, and refiner margins are doing very well. But but there's limited upside capacity to us refining more crude oil in the United States. And I'm going to talk a little bit about that when I get to those slides. So let's get into some of the data. What you're looking at here, this is one of my favorite charts because it all just came together so cleanly. So this is the global energy crunch in one chart, the whole thing. That light blue line here is the one that's grabbed the most headlines. That's European gas. This is the Netherlands TTF hub price for natural gas. It's comparable to Henry Hub here in the United States in terms of how you think about it as a benchmark. And you can see it surged all the way up here to over $67 per MMBTU at the height. This is data. This would be data right there at the beginning of March. This last data point right down there that's hard to see is the end of March. So there's no April data in here, and it's orbiting that same kind of area, low 30s right now. But of course, this changes daily. So European gas prices have come down sharply from the initial shocks, but compared to where we were a long time ago, not that long ago, I should say, they're sharply elevated. A big chunk of the rise in prices in natural gas last year was, in point of fact, Russia's deliberate attempt to restrict supply growth and basically only meeting long-term contract obligations and not shipping any extra. And so that wound up driving up costs for natural gas, which then you saw power sector pulling on LNG from the rest of the world, pulling on coal and other sources of energy to meet that gap because natural gas was suddenly very, very expensive. And we're seeing a lot of coal being burnt, and we're seeing a lot of natural gas. We're seeing talk for a while there that we were going to be pulling on oil even to burn in the power sector for a few facilities that still had that capacity. But thankfully that didn't happen, and we had a relatively mild winter. Not, thank goodness, knock on wood. Just to put all these numbers in perspective, the next two most important numbers on this chart, we see the coal prices, see the LNG prices. Brent crude, by this metric, in terms of dollars per MMBTU, Brent crude a little over a week ago was about $20. So to put that in perspective, natural gas on a per barrel basis is about 1/3 more expensive than a barrel of crude oil right now. And that's just mind-boggling to put together. Another number that's important for us to think about here in the United States is U.S. natural gas down here at $5.57 at the end of March. U.S. natural gas, very, very cheap. That spread in prices is important for us, particularly here in Texas, because what that price spread means is that there's a huge arbitrage between domestic prices and foreign prices, and that's going to push as much exports as we can, not just of natural gas, but of a lot of things that we make from natural gas, and a lot of things, industrial products that we use natural gas to fabricate or to in our processes, refined products, fuels, petrochemicals, and of course other gases like propane. We export a huge volume of propane now. All of this is telling us that oil prices, demand is strong. There's been this huge supply disruption, and our capacity and that's given us a big incentive to export more of our energy products, but our capacity to do so is fairly limited. To do much more than we're currently doing is somewhat limited because of just, we've only got so much stuff set up to do this. You can only load so many boats with so many products. Now, so we've got this big supply crunch. Demand. What is the consumer's response? Higher oil prices are definitely hitting us. And the futures curve, the expectation is that, yeah, prices may moderate further from where they are right now, but we expect where the market currently is expecting oil prices to stay high. As a result of that, and as a result of the lockdowns in Shanghai and what's happening in China and Chinese demand, you've seen the consensus of forecasters. And as an economist, I can tell you, generally speaking, averaging lots of forecasters together is going to give you a better projection than taking any individual forecast together as gospel. You see a hit to demand here, but once you get to the second half, this hit to demand from Shanghai and higher prices goes away. And we actually consensus, an average of about 8 different really good forecasters that we track, says we get pretty close to about the same endpoint for the end of the year, even with this high price market. That's averaging all the different things that these forecasters are penciling in. But if you look at this next chart here over on the right, you're looking at global inventories. You see the huge surge in stocks of crude oil and other liquids. And the start of the pandemic, you see us draw that down in the following year. And then this year, what's happening? Well, we've gone now from modest increases, an expected modest increase in inventories, to now modest decreases in global inventories. We think that crude oil market, on average, we think the crude oil market is going to be getting tighter over the year. But this cone of uncertainty is huge because there's huge uncertainty about what happens with Russia's production. How much Russian production do we lose? And I've got to say that I can't give you a firm number, and I can read you can read some of the details here, but the Russian crude output is likely already down. A lot of disagreement on exactly how much. We don't know how long it's going to stay down, and we don't know over what duration, and we don't know how deep it'll fall. The IEA and most others are penciling in somewhere between 1.5 million and 3 million barrel per day hole in the global supply and global supplies going forward from Russia. And bear in mind, the expectation was for Russian production to grow over the next 2 years, not contract. And so the delta over what the market was expecting is actually bigger. 1.5 to 3 million barrels per day. The United States is likely not going to be able to fill that gap, even if refineries thought that our crude was a good substitute for their crude around the world. And it's not. They're slightly different. And we can talk more about that in the Q&A if you like, but they're not perfect substitutes. So it's going to take output from several different countries to try and make up that gap if this thing lasts for a very long time. And I'd just like to point out that at a record discount of nearly $30 per barrel on average here this last month, Russia's still getting $70 to $80 a barrel, which I'll remind you all about 10 months, about a year ago, we all would have been more than happy to receive here in Texas. One of our surveys, our energy survey, we ask companies what their break-even prices are. In the Permian, overall, it's about $56 a barrel is the break-even cost operating to drill across the United States shale basins to drill a new well. In the Permian, and in particular, it's a little bit lower, but this prices are well above this. If you take 30% of free cash flow, interestingly enough, 30% of free cash flow away from producers, which remember, producers are telling us that they're going to say, that they are going to focus on investor returns, and you choose a number, 30%, 25%, there's a lot of different ways to think about it. If you take that extra free cash flow and you say, off the top, this is going to my investors, that means that our effective break-even cost is really something closer to $65, $70. Now, that still means there's a lot of headroom for us to go and drill and produce more crude oil, but it's another just sort of wrinkle in the story here. What's going on with oil and gas? So now we asked them, all right, well, this is an interesting kind of way to break it down, but tell us, what is the reason? If you've been listening to the news all through the first quarter, the reason was clearly regulation. It's the regulators, and the headlines were all agog about how regulation was making the industry not drill. And that certainly plays a part. And particularly you think about the opportunity cost in other sectors, look at environmental and social governance issues. You think about the history of just very poor financial returns in the sector recently, lack of access to financing. But ultimately, what they're telling us is, number one, their reaction function is mostly not dependent on price. What it really seems to be about is this investor pressure to maintain capital discipline. And yes, there is an army of independent oil and gas producers out there who will go and drill to whatever extent that they can, but they're a much smaller share of the tier one acreage now. They're a much smaller share of the overall production base right now. And so than they were, say, in 2018. And so their capacity to blow away everyone's forecasts again is going to be more constrained. That's not to say that they won't find a way, but I think their capacity of the independent producers the privately owned independent producers to really kind of blow away the production outlook is very limited. Our outlook at the Fed is about 600,000 barrels per day of production growth from the United States, exit to exit this year. Maybe we're going to round that up a bit because of what's happening with oil prices, and there will be some price response, but we think that's going to be highly constrained for all the reasons that we've talked about. Now I'm going to go ahead and skip through this because I feel like I'm taking a bit more time and just to get a little bit in the downstream. So we're pulling things in, refine what's happening on the downstream side. Distillate days of inventory. Many of you have noticed diesel prices are very, very high. And that's partly because diesel inventories are very, very low. And those two things go together. And you've seen the margins for refiners really blow out for if they want to get more diesel. But the crude, but their capacity to refine more is fairly limited. All right. And what I mean here is if you look at this, we're at about, on the Gulf Coast, we're at about 95% utilization. Okay, 95% utilization. Rest of the country is a little bit lower. And if you look at these trends here, one thing that is not on this chart, but that you need to think about when you think about how much crude oil we are refining now versus what we were doing right before the pandemic, is that nearly 900,000 barrels per day of refining capacity in the United States has been shut down over the last 2 years. It's gone, it's shut down. Two main reasons it's shut down is one, economic reasons. Prior to the pandemic, the outlook was that we were globally oversupplied with refining capacity because of new plants that were coming on in China and in India. And so it didn't make sense for a lot of our older units to keep refining them. And so we shut them down. Some of them we shut down all the way. Others, because the subsidies were in place and this push for environmental transition was already ramping up, we had several refineries around the country that are now being being refit to now become biodiesel plants. So they're not producing crude oil, but they are now in the process of transitioning to becoming biodiesel plants. And so we've lost some capacity that way. And then there's others that had to do with Hurricane Ida and some other issues, but that's basically what's going on there. We've lost a fair amount of refining capacity versus pre-pandemic. So we're not likely to be able to get back to pre-pandemic levels of crude processing unless refiners really start blowing it out, processing above nameplate for many capacity for many of their units. Now, so put all that together. Here's that QR code. So you put all that together. It says, that the energy market, oil and gas, is very, very tight. There's a lot of factors on the environmental side, on the investor side, on the regulatory side that are contributing to this restrained response that's going to keep energy prices elevated for the outlook for the course of this year. Likely, who knows how long this issue with Russia lasts. There are many who thinks that it's not ever going to go away. We'll have to wait and see. And remember, we don't know how much crude oil we're going to ultimately lose from Russia. That supply hole and our capacity to fill it, the higher prices that we're likely to see, is going to drive a lot of investment decisions. You know, there on the one hand, you've got some saying that long haul, we need to be more practical or pragmatic about the energy transition and moving away from, say, natural gas, because clearly this is still needed for those times when wind and solar underperform, not just in terms of interseasonal or intraday, but inter-year variability and output. We need the backup. And there are some who are saying, you know, that these high prices are going to accelerate the energy transition, for example, because it makes the economics look better. If oil prices are high for an extended period of time, then that makes the economics look better for the alternative in the near to medium term. And so there's a lot of things that turn and talk about here. But I'm going to yield the floor here to everybody and move on with the conversation. I look forward to the Q&A and conversation.
Excellent. Thank you very much, Jesse. And our next speaker is Chris Hosek, principal with the Texas Star Alliance. The Texas Star Alliance specializes in direct lobbying and state agency regulations. Chris has experience with a broad range of legislative policy initiatives, including a specific expertise in the energy sector. Chris served as chief of staff for 5 years with the chair of the Railroad Commission of Texas. And obviously the Railroad Commission is the regulatory body that oversees Texas's energy industries, including all levels of oil and gas industry, pipeline, gas utility rates, permitting and reclamation of coal and mines.
Yeah, Mark, thank you for having me on today. And that was a great presentation, a great overview at the global level. I found that just fascinating. And so what I may do, if you will, is just kind of drill a little bit down, no pun intended, to Texas and what we're doing here. We're obviously the largest producing state in the nation, and we lead the nation in in my opinion, regulatory policy and how to produce. And so, the conclusions in the survey you mentioned earlier were just fascinating. And so I can't wait to get to Q&A with the rest of my committee members. But just, a little bit about Texas and what we do. Obviously, I know everybody knows on the call that, we are governed by, at least on the regulatory side, by the Railroad Commission of Texas. And that is a 3-member board. They're staggered terms every 6 years. And that's on the regulatory side. And on the elected official side, we are our session meets once every 2 years for 180 days. I think most people say we should meet every 180 years for 2 days, but that is, just the direction we go. And we meet every odd year. So we met a year ago, and we're going to meet in 2023. One of our, if you want to look real closely at what we did in Texas last session, there was a lot of heavy focus on Hurricane Uri and Winter Storm Uri and the responses to that. Pretty significant legislation that came out, a lot of designation of critical infrastructure, a lot of critical infrastructure mapping. So you're seeing that you played out last session and playing out in the interim right now. So we've got several committees looking at that. But the Railroad Commission right now, they're facing some pretty significant challenges across the board. I think, just start off at the top, and you look at Permian. There's any no, everyone understands there's some seismic issues out there that the commission is looking at, and that's directly related to our disposal well situation. And there's, I think we saw a lot of action from the commission a couple months ago and kind of stemming some disposal wells and working directly with operators on how we manage this water issue. Interestingly enough, this last session, the Senate and House passed a bill that created a water consortium at Texas Tech University. So we have a university that's actually looking at this issue as a third party, how we can work with industry together to kind of solve this issue. So they've been charged to issue a report at the right before next session, so in 6 months. So we look forward to seeing that. But seismic is a big issue. Obviously, flaring on the SG side is a big issue as well. I'm proud to say, Texas has, over the past 10 years, has reduced our flaring to less than 2%. I mean, I think that's an incredible accomplishment from where we were. And the companies I work with and work for are continuing to look for ways and innovative ways to reduce flaring. And I think they recognize that as an issue, but working with the commission, I think they've been able to solve that issue. I mean, and then, we are dealing with kind of some issues that were mentioned before. I mean, we have supply chain issues that are very, very challenging. We have workforce issues. I, agree, even if, we were to give in the green light to, go full bore and drill as much as we can. I just think it's impossible to reach the levels that we were a year, before COVID. I mean, I think you're looking at a year and a half before you reach those levels for the issues listed before. Investor discipline is one of them. I think, but steel is a big one. I keep hearing from my clients right now. And as I mentioned earlier, workforce. So, there's, and I'm sure Tim is going to talk about this later, but the issues that are at the top at the federal level with this administration, they are extremely challenging for us to operate in. And, we don't plan as everybody knows on this call, we don't plan our businesses a week out or a day out. I mean, it is, you have projections a year out and where you're going to be drilling. And, when you have an administration that is openly, and this is, just my opinion, but I think it's pretty clear to everybody on the call, it's openly hostile to our industry. And we're going to see challenges. I mean, you hear the idea of methane taxes being floated around. I mean, you see what they've done with federal leases. And, when you issue a press release on a Friday before Easter, you're trying to cover that up. And I think the administration, this is Chris Hosek's opinion, but they've obviously put out, of the scope of leases you could lease only, they put up 20%, and then they raise the royalty tax on it. I mean, that's not the recipe to increase production. And so, this is where kind of our business meets the political business, right? And that's where I'm, kind of right in the middle of, and there's not a serious position, in my opinion, at the federal level to move forward with more, production. And so, I mean, that's kind of at the federal level, and we're going to get in a lot of that in the Q&A. But again, in Texas, I think we're looking at a lot of, innovative ways to kind of, deal with water, flaring. I mean, we've got some infrastructure as far as coast roads, but we're putting a lot more in transportation. On the political side of it, I mentioned earlier, we have a railroad commission race. We have a commissioner, his name's Wayne Christian. He is in a runoff. The runoff's at end of May, so it's coming up in the Republican Party. It's, more than likely, given the, political headwinds, that, whoever wins this primary is going to be the next railroad commissioner. In my opinion, I think Wayne, Commissioner Christian is in a strong position to win this. And I see him in the fall win again and be another railroad commissioner. I think the Democrats will fail to get the House back. I mean, there's always a talk and discussion about Democrats winning back the House in Texas. I have kind of a standard line on that. The two biggest rumors in Austin, Texas, every fall are the Democrats are going to win the House and UT football is going to be good. I'm sorry if you're a UT football fan, but that's the tough love. There's rumors for the last 20 years and neither have come true. So it's a kind of a quick synopsis, but I kind of, I'm interested to hear my panelists and colleagues on the Q&A. So Mark, with that, I'll kind of yield it back and let's get into some back and forth and some questions.
Superb, excellent, and thank you very much, Chris. And next we're going to have Deanna Duell with BKD, and Deanna is BKD's energy industry contract compliance leader, integrating the Council of Petroleum Accountants Society's COPAS accounting guidance and model form interpretations to meet the business and accounting needs of her clients. She helps to provide clarification of oil and gas accounting requirements for agreements in the form of contract audits and litigation support. report, including action plans to provide for contract audits and facilitating recoveries for non-operators and limiting exposure for operators in complying with accounting contractual agreements unique to the energy industry. Deanna is a CPA and in the states of Colorado and Florida. Introducing Deanna Duell. Thank you.
Hi, Mark. Thank you so much for the warm introduction and for inviting me to this panel. I take a little bit of a different hat when it comes to oil and gas, and that's somewhat just by nature of where I chose to put my time and my career. So with that, I'm going to bring up a little bit of slide decks here and also kind of highlight some. I'm going to do full screen mode here so that I can get it back, and I'll share my deck. Not a whole lot of charts and graphs, but really appreciated the economic update because, you know, a lot of what was said there in terms of, you know, observations of what's going on at the global level as well as the local level by Jesse really does kind of tie into back office and what we're seeing there in terms of issues and opportunities. So let's see if I can get this to go. So I'm going on my 25th year in this industry, and I've learned a lot being an alumni of University of Colorado, coming from Boulder. You know, suffice it to say, it wasn't something that was kind of on the radar. And it's just by chance, I think, in terms of when I got exposed to the industry as a newcomer into a family-owned business that had non-operated assets. And I've seen a lot over those years. Our company at the time was like the redheaded stepchild of the companies because pricing was pretty low. It was in the late 90s. And I've had to dig into a lot of new accounting standards. That's when the new FASB standard came out on hedging and, you know, the Enron crisis and lots of stuff happening through those years. And, you know, with that, I've seen a lot in the back office, and it's just been an interesting ride and a really good industry, in my opinion, to be involved in as an accountant. A little bit about BKD. Some of you may have heard we've recently announced a merger with DHG, and BKD is not only a CPA firm, but it's a lot of advisory consultants that are involved in this firm. Our presence going to be significantly higher or greater than it was. We're going to be ranked top 10, and we're thinking 8, and we have offices all over the nation, and none of us really know what our name's going to be. So right now you see it BKD plus DHG, and hopefully we'll know very soon. So general observations in terms of the themes. And again, I'm putting on my hat of what I know and where I come from. So a little bit about contract history. We haven't seen contracts change drastically in terms of being expedient with the times. And what I mean by that is we had, you know, a horizontal contract by the AAPL that came out it was 2015. And that was a little delayed getting drafted, and COPAS, which is the Council of Petroleum Accountants Societies, is just getting kind of going in terms of really being able to update the accounting procedures that go with that contract. We're looking at voting on that this spring here in Galveston. So I guess what I have to tell people from the geology side is, you know, keep in mind that some of these contracts that are operated by many of these companies are old and they might be outdated. There might be a lot of issues and interpretation taking place in terms of actual, execution on those contracts. And that kind of gets into where we see, some of the concerns come across our desks as consultants and as litigation support. Generally speaking, in terms of energy independence, I think what I've seen or observed is the investment dollars, the lack of investment dollars. We've seen that translate into really leaner accounting teams. And there's been a massive brain drain, I think, not only in accounting and geology and everywhere else, but translate that into less experience and more uninformed decisions. And with that, I think comes higher litigation exposure, which results in costly consequences to the clients and to companies. So it is a struggle, and I think the system capabilities, I've seen a lot change. I mean, I think in the 90s, we were still using ledger paper and starting to transition to Excel spreadsheets. Now we're doing quite a bit better, but we have some SAP, implementations that have taken place. But with that, you have to think about who is implementing those systems and what are they considering in those implementations. Are they really factoring in those unique aspects of the contracts? And what we've seen is that's not always the case. They try to do the 80-20 rule, get what what they're able to. So that's where, we've been able to come into play and help out clients and really identify some of these costs that are not being captured correctly. And then as far as changing requirements like the ONRR, when they have rulings and changes, I've observed with the COPAS, we have a revenue committee that meets and they talk about some of the impacts on their systems and how are they going to account for these things. They spend days in rooms just trying to figure this out. And I think that, again, back office hat, we're really putting a lot on what ifs, what happens if this goes into play, then we've got to have systems upgraded. Well, think about a system upgrade and what the steps that you have to put into play and the communication that has to happen. It's a lot bigger process than being able to really just turn the dial and make that change happen. So then you get a lot of off system processes going into place, trying to account and handle those things. So try as we may, it's not evolving into the best answers. And the other observation in terms of energy independence, I think with the layoffs of the industry, I think there's been a lot of people just saying, hey, I'm going to retire. I'm ready to go. I saw a lot of that with the COVID. And then that again translates into that brain drain and also the focus and refocus. So a lot of these accounting teams are focusing their efforts on, or were at least during the post-COVID time, the bankruptcies. There was a lot of bankruptcies. So your focus changes from really how are you accounting and for your contracts and your processes and procedures to how are we going to deal with the bankruptcy issues and the mitigation there. So it really just, is an evolution. And then last but not least, as far as general observations in terms of agreements, I think if you can, as a professional geologist and other professions that are in the industry, I think if you can bring in different pieces of the organization to really have those conversations when new initiatives are being contemplated. On the accounting end, there's a lot of impact and consideration that can go into those considerations. So that collaborative effort, I'm really passionate about wanting everybody to have some visibility into what's going on with their processes, how those feed into the other processes, and really just improve those processes so that you're not always having to backpedal and figure things out after the fact. Interpretation it can be misinterpretation, and really need to ground our professional capabilities as we work together to get more sound governance and predictability into the equation. So basically, going to kind of highlight a couple of things on fraud schemes that, you know, have come up, and we do have quite a vast amount of professionals here that deal with fraud, but the certified fraud examiners come out with a report every year, and I just thought that this is an interesting thing to share with this group on the payment side. And payment fraud has been very high on the radar and continued to increase post-COVID. I think we might see a little bit going down, but then this is last year's report. I'm going to show you a little bit more on last year's report for energy. They were pretty high up there in cases and medium losses, but the good news is the most recent report that came out this year, they did drop that median loss from 275 to 100,000. What's driving that? I'm not exactly sure, but I do concur the supply chain woes that are happening right now are going to be something we need to really key in on as accountants. And if you're approving invoices and doing, you know, anything with the accounting side, really got to get them involved and help them understand some of these aspects of what might or might not be coming down the pike in terms of the P&L and assets you're acquiring. I've got a few resources that I'm happy to share with the group. We've got a website that just talks about our energy side of things, and a few articles that I'm highlighting here. We do have an ESG team that is there to really help kind of facilitate that ESG framework and really initiate on that in a strategic and logical way for clients. OGVR, that's just something that maybe you'd have an interest in, maybe not, or maybe you want your accountants, if you have accountant colleagues, to get plugged into, but that's the oil and gas vendor roundtable, and it's under vendoroaudit.org. It's a really good group that really contemplates what's going on. We've had sessions about water haulers. We're trying to get a session together on the supply chain coming up. If anybody here is interested in talking to that group, please reach out to me, because I think it would be great to get perspectives on the supply chain from others outside of the accounting side. And then as far as COPAS, they're basically the establishers of how accounting kind of should get done. It doesn't always get done that way, but they provide guidance and model forms, interpretations, that sort of thing. We have an emerging issues team, and I think somebody on the panel is going to talk a little bit about carbon credits, but again, that's an accounting issue too that we need to think about. So always having to fold in the accounting back office anytime you're dealing with anything, because there's consequences, and it's really, really important that we're kind of on top and on the forefront of that. And COPAS is always looking for speakers as well. So we welcome that as an organization, and we're meeting this spring in Galveston, and we're talking about the updated accounting procedure to the 2015 AAPL model form agreement. ESG reporting for DHG, which is who we're merging with, they've also got a good navigating and disclosure landscape out there for folks. And with that, there is my contact information. Feel free to reach out. Happy to connect the dots for people that might have questions or want to get in touch. And I'll go ahead and turn it back over to you, Mark.
Excellent. Thank you so much, Deanna. I really appreciate you and BKD for the education and supporting the Houston Geological Society. And so next we're going to move into a hybrid fireside format. And as I said, in the chat, feel free to write 622. So it's definitely happy hour somewhere. And so we'll be introducing Tim Tarpley and Marcella Burke and going into the Q&A session. So Tim Tarpley is Senior Vice President of Government Affairs and Counsel with the Energy Workforce and Technology Council. Tim oversees the energy workforce's policy, government affairs, international trade policy, environmental policy, Mexico task force, and legal committees. Thank you so much. And then also I'll introduce Marcella at the same time, as she'll be intermingling and answering the same questions as well. And so Marcella Burke is a partner at King & Spalding. Marcella Burke leads the Houston office's environmental health and safety practice, and she counsels the energy, environmental sector spectrum, including carbon capture, conventional oil and gas, hydraulic fracking, renewable decommissioning, energy technology permitting, crisis management, environmental enforcement, and environmental investigations. She leads the firm's Energy Transitions Initiative as a member of the Houston ESG Council. I could go on and on. She's very lettered. So go ahead, Marcella and Tim, and then I have some questions to lead you off into. So, Tim, the war in Ukraine has drastically changed the geopolitical situation, especially in respect to how do you see the Biden administration shifting their oil and gas policies in response to the current issues we are facing?
Yeah, thanks for that question, Mark. I think that is, the Ukraine-Russia crisis has, at least in my opinion, changed the energy dynamic, not just here in the United States, but all across the world. It certainly seems that energy security is kind of now the primary concern and interest in any politician's mind, whether or not you're sitting in Washington, D.C., or you're sitting in Berlin. This crisis has been a reminder of just how important energy security is, and having either a domestic supply of energy or a supply that you're very confident in from your close allies. So that calculation has changed everything, and obviously we have price increases, which puts pressure on consumers. And there's, inflation going on that puts a lot of pressure on, politicians here in the United States. So I do think that the Biden administration is facing increasing pressure to change their policies. They, and Chris mentioned this a little bit during his intro. Obviously, they came kind of right out of the bat at the beginning of the administration with, ending the Keystone Pipeline, with the moratorium on new leases, both onshore and offshore, as well as pushing for a number of new taxes and fees in what was at that point called the reconciliation package. So they kind of came out swinging pretty hard against the administration. Now, as I said, things have changed. If you look at polling, the American public is about 60 to 65% supportive of developing domestic energy, including oil and gas. That's pretty high polling for considering the polarization our society's in. I mean, very few things poll above 60% anymore. So I think the Biden administration sees that, and they've certainly changed their rhetoric to some extent. They have pulled back on some of their anti-LNG export positions. They have certainly come out in support of the industry. It's made statements more supportive of the industry. However, the policies really haven't changed. at least as far as I can see. Chris mentioned, just over the weekend that, facing increasing pressure, both legal and from public opinion, they restarted the leasing program. However, they took 80% of the total leased areas off the table. We still haven't seen the list for the lease parcels that will be leased, but based on the numbers, 80% of that is off the table. And they also increased the royalties onshore from 12.5% to 18.75%. So certainly, the rhetoric isn't really matching the policies, and we do see, policies coming out of the administration that are not going to really support the increase in domestic production that we really need to address the geopolitical situation that we're in and to help lower prices here domestically. So it's a little bit of wait and see on how that plays out, Mark.
That was a very descriptive answer. Appreciate that, Tim. Marcella, would you like me to repeat the question, or are you good to go?
I'm good to go, but I'll let everyone listening know, if you haven't been following on your phones, that United Airlines lift the mask mandate. So I feel like that's probably the most important thing anyone on this call would like to hear today. And I'm flying to New York tomorrow. So I'm very excited about that news myself. But
okay, that's freaking awesome. Sorry, but that's freaking awesome.
So yeah, it's legal. So I figured, it's perfectly acceptable for me to mention that. But a federal judge struck the mask mandate. And so the TSA doesn't have to require it, and up to each individual airline. And United has said they're not requiring masks. So, but as far as how the war in Ukraine is affecting the geopolitical energy sort of market, I think that what it's done domestically is, I agree with everything Tim has said about the administration still not being particularly, setting up policies that are conducive to nimble oil and gas market and especially nimble exports. The Ukraine situation definitely shows that just people, citizens, American citizens, are seeing on a day-to-day basis how important fossil fuels are and how important it is to have energy security and what those words mean on a practical level. And so to the extent just the general public can understand what it means to have energy security, I think that's a good thing for the industry. It's a good thing for energy policy. And it's showing us that there's not a lot that can be done completely and entirely to replace fossil fuels, nor should there be. And so it's whatever solution comes up in the energy transition, to the extent there are other substitutes in the market, competitors with oil and gas in the market, and to the extent the government sort of chooses and picks winners and losers. I think the Ukraine situation is going to exert pressure on the government to support that both and approach, and not do what it's been doing, frankly, to choose winners over losers. So that being said, I think the energy market itself still has an appetite for alternative sources of energy. And so we see this in the LNG market with a number of firms saying they'd like to convert their plants from gas to hydrogen, for example. And there's a market for that right now. You're seeing a lot of movement, or you're still seeing lots of carbon capture action. And so I can speak separately on that later, but to the extent that the public and therefore, our policymakers are looking for a net zero carbon emission world, then carbon capture is going to play a role in any of its, multiple forms. And so we can expect to see regulation on carbon capture as being part of that equation as well. And so carbon capture might be a good both and solution.
Excellent. Jesse, do you have any points to chime in on that, or?
No, I think that was very good. Just to throw in a little bit of economist speak on this, to think about it, in terms of the impact, because we've heard a lot about it, and I think certainly if you think about the Biden administration's policy, particularly for offshore, and sort of where they've been on their messaging and, they're issuing new leases on federal lands, or they're not. And what is the impact on pricing, and or not really so much price, what is the impact on U.S. production? I think it's important to remember that these things operate on very different timeframes and on very different production bases. So, for example, federal lands, I'm spacing on the exact percentage, but it's a small percentage of total production and a small share of the total production growth. The underlying reason why the shale revolution was even really possible in the United States was because the majority of the resources, not just the physical resource, but the infrastructure necessary to move it, was held in private hands and was on private lands and on state lands, and oil-friendly states like Texas. And so, the vast majority of the production base and the growth has come from those privately held lands. So we got to think about that sort of characterize where is the risk there. And then the other thing you have to think about, and this is really hard for even the most seasoned salespeople in economics, I'll say, is to say, what would have happened had we had a different policy in place? And so, for example, you say, well, are we going to be restricting new leases on federal offshore, for example? And we think at the Fed, that's really where there's a bit more meat in terms of impacting the longer run U.S. production outlook. Is what might happen offshore is that, if that goes into place, well, how much drilling activity, how much exploration was there likely to be in the U.S. Gulf of Mexico anyways over a time frame relevant to that policy, right? Now, and so that's really hard to say, because remember, a few years ago, the narrative was, well, yes, there's some great opportunities in the U.S. Gulf of Mexico, but really the greatest opportunities in terms of resource development, research, where's all the exploration? It's in the emerging world. And it's in Brazil, it's in Asia, it's in West Africa. And so that's where the offshore CapEx dollars were going. When we look at LNG, not that long ago, remember that the notion was that there were like 20 different LNG things in permitting and in the pipeline. And not that long ago, the thought was, well, the world's LNG market really wasn't ready to absorb the volumes of natural gas that we conceivably could export. And we crushed the global price of LNG down to the point where your $4 cost for liquefaction, your $3 to $4 cost of liquefaction, eliminated all your margin. And so you weren't going to ship. And because you were tied to long-term contracts, you had to really think about these things. And so the LNG story has been very, very slow moving, and it's going to be slow to change course. Although I think, as Tim and Marcella were pointing out, that ship has definitely, the rudder's definitely turned, and that the world is going to be looking for more methane from the United States longer term.
Excellent. And do any of the other panelists wish to chime in on that question? If not, we will how has the administration's views on natural gas changed for the last 14 months?
Mark, you keep cutting out, so you need to get really close to your mic.
Well, I'm aware of that. Can you hear me now?
Yes.
Yes. All right, wonderful. Thank you so much. And so if none of the speakers wish to chime in, Tim, how has the administration's views on domestic nat gas changed over the last 14 months, and what are the implications for our sector?
Yeah, I think there's been kind of I spent probably the first 7 or 8 months of the administration trying to figure out exactly where they were, and I don't think they were sure. One thing you can say about the prior two administrations, President Obama and President Trump, there wasn't a whole heck of a lot that they agreed on, but there was some consistency on supporting U.S. natural gas and U.S. LNG exports specifically. There was, at the beginning of the Obama administration, there was the slowdown with FERC on exports. But, aside from that, there was some consistency. When the Biden administration came in, that wasn't so clear, especially, the signals that were sent to our allies, I think, were conflicting. Folks that were looking to purchase, make large long-term contracts. Obviously, if it takes many years to build an LNG import facility, they want to make sure they have a steady supply from a friendly country before they do that. And I think there were some mixed signals sent. One of them was the State Department had this new policy that they weren't going to support projects that were, unless there was some sort of element of carbon abatement. They weren't going to support carbon intensive projects. They weren't going to, support the financing of those. That kind of made folks wonder where the administration was going to go. I think that has changed, though. I've seen a walk back of that policy, specifically, and then also obviously the president, when he spoke with our European allies and made significant promises for additional LNG export promises, that sends a real strong signal to our allies over there that when the president is making those statements. However, that's going to take policy changes domestically in order to support that kind of export. It's also going to take energy infrastructure investment. You're going to need pipelines to get that product to the LNG export facilities, and you're going to need more LNG export facilities. All of those are huge investments. Huge regulatory steps need to be taken in order to do that. So, I think time will tell if that continues, if that support continues. I think also there's some concern in the folks that we work with is this really a long-term change in view, or is it, okay, we just got to get past this crisis and then, we'll kind of go back to the old policies. There's obviously a concern out there that could be the situation. So some investments are holding back to see, is this real? Is this really a change in tune? So I think time will tell. I certainly hope. I think, the U.S. natural gas is actually one of the reasons, the primary reason actually why the U.S. has lowered its emissions so significantly since 2005, and that's transitioning coal-fired power plants to natural gas. So I think it's a great asset that we have, and certainly if we can share that with our allies, it's a good thing for everybody. And so hopefully this is a long-term policy change.
Excellent. And same question to Marcella, Jesse, Deanna, and Chris. And if you would like to turn your camera on, feel free to do so, so that we can, see everyone's faces. Thank you. Marcella?
I'm on the LNG piece. I think that we're going to, I'm not an expert on LNG specifically, but I'm seeing in the market at the firm, our LNG practice right now booming internationally. So that makes a lot of sense. I think that when we think about LNG and we also touch on Jesse's point about offshore drilling, when you see an increase in the market internationally, it's often just, an economics. And so we talk about drilling offshore in other countries, but often those countries don't have the Clean Air Act and they don't have any of the other sort of Leviathan environmental regulatory regimes that we have here. And so the industry is going to respond to overregulation. And right now LNG is feeling the squeeze. And so they're going to go internationally for sure. And I think that some part of why they're doing that is just a response naturally to economics. And so that's just going to be, where we see some of that production going forward, for sure.
No, I absolutely agree. Now, that's one of the reasons why your lift costs, your operating costs in so many other countries that have easy access or decent access to natural resources, why they're lower costs is because they don't have our regulatory costs or our labor costs or our labor regulations or any of that. It's absolutely fair. In terms of scalability, very few places have the infrastructure necessary to scale their natural gas prices like the United States and Australia, for example, do. Now, one point I do want to make to sort of to Tim's point about a shift in natural gas and LNG that was happening, and shift on methane that was happening from the prior two administrations to the next one, is that we also got a little bit, I just want to make sure it's clear, we also got more information about just how much methane was leaking. Which we didn't know before. Quite frankly, no one had really authoritatively, comprehensively measured it. And there's a lot of work going on by some very innovative companies trying to figure out exactly how to measure that. And I think if I'd certainly, from where I'm sitting as I can't issue a preference here in terms of policy, but if you can get some type of price signal on transparency on that, it's one of those things I know the market will solve that problem. But so we didn't know how much we were leaking, and that by that same token, we didn't know how bad everyone else was either. And so if there were some type of pricing mechanism that said, this is the methane leakage associated with production here and there and everywhere, well, that's information that can be turned into driving the right incentives to get, say, production in places that are cleaner, like the United States, in places that have the engineering and scalable applied engineering work capabilities to solve that problem. So I think we are going to see a lot more LNG going forward from the United States. The question is, within Texas, it's not a question. Within Louisiana, it's not a question. In terms of getting any extra natural gas out of the Marcellus Shale or other places, well, we're going to have to build more pipelines to do that. And that's going to be a big question for those regions. So definitely Texas, but other parts of the United States, it's going to be hard to see them ramp up to supply that marginal natural gas to the world.
Excellent. If none of the other panelists would like to chime in on that, I have a question for Chris. Texas is the largest producer in the U.S. What is the Texas legislative sentiment towards the industry? Chris? Okay. All right, so we will join, we'll get back with Chris. So, Deanna, where does the industry go to address contract counting matters?
Thanks, Mark. That's a good question. And I don't know that there's one great place to go, but I know a lot of attorneys that specialize in contract areas, specifically oil and gas. I think involving the attorney first and foremost is very important for those types of things. But as far as compliance, read your contracts and make sure that you know what your capability is on the audit side, because there's oftentimes things that are being accounted for and inappropriately, just not necessarily by virtue of not wanting to do it right. It's just by virtue of the back office. I mean, there's just issues there. So keep that in mind. And then as far as Council of Petroleum Accountant Societies, they have a number of, documents and forms, model form interpretations, and accounting guidance that you can go to as reference tools. But as well as I'm thinking about education now, that they are developing a lot more education out there for accountants, both at COPAS as well as PDI, Petroleum Development Institute. So there's a lot of resources out there, but it's not a one size fits all, and really have to kind of go all over the place, I think, to know where you need to narrow your focus and bring in the experts that are necessary for that.
Excellent. And for our, I guess, solo entrepreneurs out here, or some of our entrepreneurs in the audience, who do you suggest that, what do you suggest that the regulatory team looks like? They have it internally or externally? And Marcella, you can chime in, and Deanna. Marcella?
Can you type the questions, because you came in and out?
No worries, thanks.
Oh, I think were you asking about the midterms? If I understood correctly, what are the implications of the midterms at the state and federal level, and how would those outcomes look? And so thanks for sending that note. I think that the impacts of the midterms are enormous, that if Republicans take the House and the Senate, then it will be virtually impossible for the Biden administration to affect the industry legislatively. And so it will put focus on executive action, which is more susceptible to court challenges. And I was the deputy general counsel at the Environmental Protection Agency, and also was at Department of Interior, where I managed the onshore and offshore legal litigation docket. So lawsuits from environmentalists, challenging rulemakings, challenging permits, all that kind of thing. And I think that what we're going to see with gridlock in the legislature is that a lot of the decision making will go down into the agencies like the EPA and like the Department of Interior, and there's going to be lots of litigation and lawsuits. And so that's just going to slow stuff down. It's, you know, anytime something gets stuck in a government agency, you know, you have sort of that's going to slow things down. And then when you have lawsuits involved, that's going to slow things down even more. So I think Tim is, you know, really our resident expert on this panel on sort of the effects of federal legislation and things like midterm elections on a federal level, and then Chris Hosek on the state level. So I'd also kick it down to them.
Yeah, thanks, Marcel. I'll jump in there. I think you're entirely right. I think the midterms are going to be incredibly impactful, especially if it's a wave election, as if you look at the polls, that could definitely happen. Everything kind of shuts down all of a sudden, you know, depending I think the House is, I never say sure thing in politics because, you know, the past 3 or 4 years, I mean, just the scenarios that have played out have been so unpredictable. But, you know, as of now, certainly if you look at polling, it certainly looks like the House will flip. The Senate may be a little bit closer. So, you know, if the House flips, the Senate doesn't, they're going to have to play ball. They're going to have to, you know, negotiate and make deals. If they both flip, then just everything shuts down. And, you know, the administration, like Marcella said, is going to have to just rely entirely on rulemaking, because that's all they're going to really be able to do. Especially the way things are polarized right now. There's virtually the margins are so slim. You only have a couple of members on either side that are really willing to negotiate and vote with the other side. It's such small margins that, you know, I think that's important to note as well. And we'll see how much the House flips, you know, what those numbers are. I think the bigger margins the Republicans have, the more they're going to be able to keep their caucus together. So it's important to watch not only if it flips, but how big it flips, you know, both on the House side and on the Senate side as well. I think whatever happens, you know, folks like Manchin and Sinema are gonna remain very important and impactful to our industry, because they're willing to stand up to their own party. So even if the Senate were to flip, they're both going to be still very important and impactful.
Super. And Chris, are you available to take that question? This might be a session. Okay, perfect. So the next question is to Deanna. What have you observed as the top issue for contract compliance in oil and gas from an accounting perspective, and then Marcella from a legal perspective?
I think the top kind of most recent issues really have come down to, I guess, timing, really, in terms of identifying issues in time to really matter. Because the longer you wait, the harder it is to really go back and look at those deviations or what have you. So timing, I think, is something that I see a lot of, especially in a environment that it's like, oh, well, we need to recover some costs, so we need to audit today, and as opposed to saying, you know, let's schedule this, let's get this on the radar. It's reactive as opposed to being proactive, and that really hurts, I think, in the long run.
Excellent. And
Sure. I mean, I think as far as contract compliance goes, on sort of the transactional level, I deferred to Deanna on that. As far as deciding whether or not to begin a large scale project and where to invest on the investor side, I think that one of the big effects is geopolitics and what's going to happen and predictability. And right now, there's just not a lot of predictability in the market. Not only do we have midterms coming up, but it's not going to be too long until we have another presidential election. And it's kind of nice. I can't remember the last time 2 years before an election, we didn't already sort of have political ads coming up. But it's almost as if nobody wants to think about it. But it's going to be around the corner. And so if the current administration is not in the White House, there's going to be more back and forth in the market. And so there's just a lack of predictability, I think, that harms large scale projects. I think in general, and as far as the law firm market goes, the scale of firms that do these types of major projects for oil and gas, we're in a boom cycle right now. And I think people are preparing for sort of a bust and slowdown to come up around the corner. No one knows when. COVID was very, very busy for lawyers, not just because litigation, but there were a lot of deals done. People saw that there was going to be topsy-turvy in the market. And so investors were, doubling down. And I think we'll be seeing that that's going to slow down a whole lot coming up soon. So that's not really a contract compliance question, but as far as the market for doing big deals, I think there's just unpredictability, and we'll I'm curious also to see sort of what happens in the market.
Excellent. And our next question in the chat is to Tim. Tim, the organization was a strong supporter of the REGO Act, federal orphaned well plugging program that passed in the infrastructure bill last fall. How can the industry fully benefit from this program?
Yeah, thanks for that, Mark. I think this it could be a potential very significant opportunity for a lot of the companies we represent. We represent 450 companies in the service side of the energy sector. Many of these companies do this kind of work all over the country. So it was certainly a big deal for us. The bill itself kicked around. There were versions in both the House and the Senate, bounced around at the beginning of this year. I think it got to a good place. It was bipartisan. You don't see many packages, bills like the, truly bipartisan bills that make it all the way, at least this Congress. It passed as part of the bipartisan infrastructure bill. Ended up not being the final bill, and ended up not being that bipartisan, but it was, at least at its onset. Well over $4 billion for well plugging programs around the country. The money flows through the states. Most states already have a established well plugging program. So this is going to just inject more money into those programs. Obviously, companies that are already doing this work are the most best positioned in order to get the contracts for the additional work. The most of the process for going out and signing these contracts is going to be done by the states. There are federal steps that the states must follow, but generally speaking, the states are free to follow their currently existing programs. So what we've been telling our companies is, hey, if you're already, licensed and you're already doing this work with your current state program, you're kind of well positioned to get these new contracts as the money starts coming in. Some of the money's already hitting the states. We're going to see probably most of it get out here in the next few months. So we're working quite a bit with our companies on how to access those funds and how to best take advantage of the program.
Jesse.
Yeah, no, that's very interesting, Tim. And I have a question for you then, and for Deanna and Marcella, anybody who can add any clarity on this for me. But, each of these orphaned wells, for example, represents a net present value of total methane emissions or leakages that may occur over an extended period of time. If you had a market signal that is tied to that, if you, in a carbon accounting scenario, you could turn that liability that costs you something to plug into, at least to some extent, offset some of that cost, at least some of that cost as a carbon offset in the carbon accounting. And is there any move towards that type of regime or rule that would bring that kind of market forces to bear on solving this problem, where we could provide us an incentive beyond just do it or we'll be mad at you to plugging some of these old wells?
So, Jesse, I know that COPAS is addressing this in our emerging issues, the carbon accounting issue, and that's coming up next week. So I'd have more to report back on kind of where we land there, but it's definitely on the radar.
Okay. Thank you.
I mean, the plugging and abandoning has been an issue, especially offshore for such a long time. I mean, I hate to say especially offshore, also onshore, surely. Offshore, there's been a financial assurance rule out of an agency called BOEM at the Department of Interior. And this was one of the rules in my portfolio when I was there. And that rule basically, will decide and decipher who is responsible on a chain of title for P&A wells when we've reached the end of a development and there's no one left. So, the last firm has gone bankrupt or is, off the lease, and the government sends an order to decommission and plug and abandon, and who's gonna pay for what. And the current regulations are that basically the government, in effect, the government will send an order to decommission to anyone on the chain of title, and then that company can just sort of sue everybody else for indemnification. Technically, you're only responsible for what you drilled while you were on the lease. And so if you were on the lease and while you were there, you only drilled 4 wells, well, then those are what you should be responsible for. What the regs say is that, they'll ask you to decommission everything and you got to sue everybody else. So what if you're the last man standing and everybody else is bankrupt or been bought or sold or whatever? Well, then you should technically pay your fair share, and then the rest goes to the taxpayer. And so it's a huge problem. We don't have anything for plugging and abandoning wells that's like a Superfund site where industry sort of all chips into a huge fund, and then that fund is used to remediate. There just isn't anything like that. There's been talk about that. And so there's, and then you mentioned sort of this carbon question, and I think that's really an interesting legal question. Well, first of all, you said, what are people going to do? Well, they're going to do what the law tells them to do. And right now, this law is not telling them to do much more than P&A what was their responsibility. So that's what I think they're going to do. As far as what will they be responsible for, sort of this carbon emissions and ongoing emissions, almost like this downstream greenhouse gas effect or whatever you want to sort of call it with methane emissions. That is something that has not come up in the regulations. I don't even know if that's come up in comments to proposed rules. And so right now, I don't even know if the government's considering whether or not they should sort of have a scheme for making their, regulatory liability for downstream effects from failing to plug and abandon. So anyway, if that answers your question, I think the plugging and abandoning and the carbon capture, the carbon credit question, is a very sophisticated question. And it's very something that's sort of something the government hasn't quite caught up with yet. And so right now we're still in the 1996 Clinton era plugging and abandoning rules. So we're not there yet. The last couple of administrations have tried to update the rules and it hasn't happened. We tried to do it when I was there. It didn't happen. I think the current administration is trying to do it, and we'll see if they can get it through.
Interesting. And then, Marcella, are there any other regulatory hurdles you anticipate in the carbon capture market, or have you touched on everything?
For carbon capture, well, carbon capture is sort of a separate topic, and I bring it up in that to the extent, I'd mentioned earlier that in a net zero world, carbon capture is going to be just part of the equation because it's seen as part of the both and future of oil and gas. I mean, methane emissions, we have not reached a place yet where we can basically have zero emissions. It's just not, there's not technology right now for that. And so as we've discussed, there's more of an appetite and sympathy for wanting to increase U.S. production. And so how do we do the both and? Well, if there's going to be methane, well, then these companies should have to offset them by capturing carbon somewhere. There's the whole carbon credit market. That's sort of a whole separate conversation. But as far as, what is it then about carbon capture? Well, there's different types of carbon capture, different types of things that you see energy companies doing in the market to sort of make up for those inevitable emissions to reach that quote zero. And so there's pre-combustion capture. You're extracting CO2 from hydrocarbons before combustion. Then you have post-combustion capture, where you're capturing the CO2 following the combustion of hydrocarbons. There's oxy-fuel combustion. You're combusting hydrocarbons in like a pure oxygen environment as opposed to in air. And then there's direct air capture. There's capturing CO2 directly from the atmosphere, and that's using a series of chemical reactions. And so really what we're usually talking about is direct air capture, and then sort of a fuel injection capture where you're injecting the CO2 into a well, and you're using that injection to actually sort of propel what's left in the bottom of a well out. And so environmentalists don't typically love, frankly, either. Direct air capture, you're putting carbon, which is seen as potentially a pollutant, right, straight into some sort of a cavern, right? And so this is the geologists on the phone will know that this is very risky, that we don't know a ton about what the reaction is going to look like. There are certain companies, when I was at DOI, I did the legal for the carbon capture program. And we had some leases for carbon capture that were years, decades. I mean, the majors have been doing this for 20 years. And so, but no one's really sort of been paying too much attention. So to the extent you're capturing in, say, a salt mine, all this pollution, what's seen as pollution, if there's any leakage or anything like that, I mean, that's just decades of litigation waiting to happen. And then to the extent you're using carbon to sort of, you're injecting it and it's staying in the ground, yes, but you're using it to get more oil or gas out of the ground. Well, that's not something that environmentalists love either, because you're still enabling the oil and gas industry. So both of these there's lots of call to regulate both of those major types of carbon capture. And we're seeing that all the time. In this administration, the Council for Environmental Quality, which is basically the White House Council for Environmental Law, they just sent out new guidance in February on carbon capture. And so in that guidance, you see what could be seen as a number of hurdles to go through before you can get a permit for carbon capture. And so it's already can be it can be 7 years before you get a permit for carbon capture easily. The last administration tried to get those permits down to about 2 years. And now we have new hurdles sort of put up. So basically there's new stakeholder consultation meetings. So to get your permit, you need to evaluate the proposed impacts of carbon capture on the host communities. You need to do tribal consultations. There's all these, quote, environmental justice concerns. So there's basically a new consultation structure set up that would be on top of the current regime. So there's no want for federal regulatory hurdles, legal hurdles in the states. Well, it varies state to state, but I mean, even from the very beginning, getting your lease, is it a surface right? Is it a mineral right? Is it both? Well, it depends on which state you're in and what the litigation history is. I mean, so it's pretty complicated. I mean, carbon capture is not something where you can just turn a key and get a permit, get a lease, and just, start getting that net zero. So I think there's a lot of regulations out there, and we're going to see a lot more. I don't know if anybody else has anything to add to that.
Yeah, audience members, if we have geologists in the audience, like Marcella indicated, we do want to turn into a conversation. Don't play Zoom hide and seek like that myself several times. So,
Mark, I have a question then.
Go ahead.
So,
go ahead,
Mark, can I ask my question?
yes, you can.
Thank you. So this is a bit of a follow-up to Tim about the Regrow Act, but also ties in to the carbon capture. And yes, I am a geologist. Because it seems like all these things are tied together, right? If we're actually going to be able to actively utilize some of these depleted reservoirs for carbon capture, then we have to be sure that old abandoned wells are plugged. And as water resources are becoming a more critical item, and the petroleum industry uses a lot of water resource, there has to be this partnership between groundwater resources and the petroleum industry. Is there anything in the Regrow Act that's meant to actually encourage this further collaboration between those two industries? And are those two industries then combining in a way that can help with carbon capture? And to Jesse's comment, very old stripper wells or low production wells, the ability to detect the methane emission would have to be at a hypersensitive level. A lot of the satellite monitoring that you see now is meant for wells that are actively producing today. And so there's actually a thermal response as well that you can see. So it would be getting the technology to that kind of detection level. And then is it worth it to try to calculate that type of a credit for what is a really probably super low emission that most of the time you're going to see when it rains, because that's when latent gas will bubble to the surface. So it just depends on where do you want to bang for buck, where do you want to spend your money. But I think plugging these wells is huge, and it's a huge problem. So Tim, I just wanted to know if you could comment on the Regrow Act a bit more about if it's meant to encourage a collaboration between those two industries.
Yeah, that's a real good question. So the final bill that passed, I don't know the exact total in funding, but there is money for both DOE and Interior for technological development and long-term studies about orphan wells. So conceivably, some of those issues could be covered in those funding streams. But at least in the discussions I participated in, there wasn't specific funding streams set up for that, but there is money that could potentially be used for that.
It seems like that's a real missed opportunity, because these two industries working together, right? Surface flow and subsurface flow, it's a similar skill set. And that water resource question is going to become an increasingly dominant question for the United States, especially in these drought communities. So plugging some of these wells so we don't contaminate the groundwater resources that we already have would be huge. And if you could do that in conjunction with the two industries, it seems like you could get more traction. So I know this is a conversation that's going on in a lot of universities that are land grant universities. I just didn't know if there was some specific to that. So it sounds like no.
Not that I know of. Somebody else may know something I don't, but not that I know.
Okay, great. And then if we don't have any other responses to that question, so Deanna, how are joint venture partners handling additional regulatory and legal issues that result in higher operational costs to drilling and developing wells?
Yeah, the costs that come up when it comes to environmental and regulatory are addressed in the joint operating agreement, and they're addressed in a number of ways. So I think it depends on the type of costs that you're incurring. So for instance, if it's something for, say, an ESG program that you're putting in place and it's more administrative, that might be covered in an overhead type category cost, where if it's something that is like a technical person has to go out to the well site and actually deal with the environmental remediation, and it's applicable directly to that well site, then there's some direct chargeability there. So again, it's not really, one way. The agreement really dictates that. And if there's some ideas of, potentially incurring a lot of costs in that area, I would recommend you really kind of come to an agreement as to how that impacts the joint account and whether or not you can get your partners to sign on or sign up with a maybe different type of agreement to take care of some of those costs outside of the general JOA that may not address the excess charges you're dealing with. So
excellent. And then do economic anomalies impact the accounting and compliance of contracts, Deanna?
I'm sorry, I couldn't hear your question.
It's in the chat.
Oh, economic anomalies. I think so. Definitely when the economy is kind of in the dumpsters, when pricing's low, we see a lot of people kind of coming, trying to deal with their contracts, trying to figure out cost recovery when things are going well and people are just kind of going with the flow and they don't necessarily think too much about it. But I think regardless of the scenario, as you're going to always have those kind of ups and downs in this industry, just getting on board with a consistency in your contract compliance initiatives would be very helpful and would really save you down, when those downs come and the highs, as well follow through. So that's just what I advise, is just getting on some sort of consistent program.
I appreciate that. And what do you see as being around the corner for contracts in light of recent regulatory events, Deanna?
Well, I think that I'm kind of interested in the whole Bitcoin aspect and what that's happening out at the well site. I hear a lot of the royalty owners. I belong to the National Association of Royalty Owners and kind of plug into that group as well, because it really does beg the question as to, how are you paying for kind of the flow of this production that might be capturing that methane and using it for Bitcoin mining. And I think we're just getting into that area. And I think that's also going to be something we'll bring up as a really interesting topic to address at the COPAS, maybe the fall conference. So if anybody has a good speaker to talk to what those operations look like, I'm very interested in learning more. And I think the WOGA as well. I'm on the board for Colorado Women in Oil and Gas, and we do technical sessions as well. It's just, I think, overarching an industry topic that would be very fascinating to dig into.
Excellent. Jesse, and I know you're out in the market. What are you seeing with regard to Bitcoin mining and flaring?
Nothing, because that's just not anything that I'm focused on. We have another team that's focused on Bitcoin. Of course, our interest is mainly in thinking about a central bank digital currency and what does that world look like, and what are the risks and liabilities from a regulatory standpoint on banks dealing with cryptocurrency and all of that. So we come at it from a very different angle. So it's just not something I'm up to date on.
No worries. Marcella, Tim, are you seeing anything in that space?
I'm looking up right now on my email because I have an article I've been outlining that's basically the Department of Energy has a number of significant grants, and arguably those grants can be used for Bitcoin mining. And so I've put together a presentation on that. So I won't bore everybody with all the details, but anybody can, email me if they really want to hear the nerdy details of what all that funding could look like through the Department of Energy on Bitcoin. I also know some of that because I have two separate clients that are oil and gas clients that are looking to use gas for mining of Bitcoin in the Permian. And so, and out of Midland. And so I think that you're just going to be seeing this, and whether or not you can get funding for it is definitely up in the air. And people are, asking lawyers to look that kind of thing up. I can't imagine I'm the only lawyer who's been asked that question. So I think that we'll be seeing that. Now, some of the Department of Energy funding, you sort of have to make a case. They're gonna want to hear why should they be investing in you as part of the sort of energy transition. And so there's going to be a policy question on whether or not the administration wants to support an alternative sort of source of currency. And so there's sort of like layers of policy questions within the opportunities. So whether or not you get federal funding, I don't know. And this administration question, the next one, whatever that administration that is, it's sort of Bitcoin mining is so new still. I don't even know if the political parties know what side they're on. And so I think the polling has yet to be conducted on what people should think about that, where it's being conducted now. So, I'm such a cynic. So we'll see. So the market opportunities, but for Bitcoin mining, I mean, it's sort of get in there now while you can before it gets regulated, is sort of, I don't know, don't call it a suggestion, but just, and I can comment also on sort of what Deanna said earlier about what's happening in the joint venture world and contracts and sort of what are we seeing with additional legal issues and JVs in the market. And with that, I just want to point one thing out, which is sometimes industry will get into JVs and they'll earnestly believe that, this plugging and abandoning liability or this environmental risk or whatever the risk it is, we haven't done our geology on this carbon capture project, but, the seller has agreed to assume all of those liabilities. So we're not contracting for that. So it doesn't matter. Or in our JV partner has decided to take the environmental risk. So it doesn't matter. Well, that's not true. You cannot contract out of your regulatory liability for any environmental on federal land. So basically you should see it as two contracts. The lease is your contract with the government. That's how the government sees it. And your JV or your JOA is your contract with another company, another party. And so whatever you contract between your party, the other company for who's liable for what in 20 years, it doesn't matter because the lease is like flypaper. And once you're on it, you're stuck forever. And so as long as you're in operation, the government can still come after you. And a lot of companies take that for granted. And they think, man, I got this killer deal. And we priced all the environmental into the terms and our reps and warranties and our covenants. And I really killed the guy because, I'm not taking any of that. Well, that's just not true, especially if you're a significant company, you're one of the majors, you're going to be around, your business model is to be around for a long time, then you're going to be responsible as opposed to some of the nimbler private equity backed maybe or financially backed companies that are just built to sort of flip and sell and to have an exit. Well, those guys are going to be out of the market. And so if you're doing a deal with someone like that, you got to really make sure you understand the lease versus the contract because they might be telling you you're not responsible for anything ever. They're not planning on even existing in 2 years. And lo and behold, when there is a problem, the government's going to come after whoever's on the chain of title. And that's you. So if that doesn't make sense, I'm sorry, but for those of us who do sort of the contracting part of these leases and operating on these, on these leases, that's something that comes up all the time.
Yeah, that's not yes, I have personal experience with that, having worked for a major, and that's what makes selling an aging asset very, very difficult because most smaller companies do not escrow for P&A liability, which is going to come down the road. And you get to the end of an asset life where, basically the production you're making is not offsetting your cost and you're looking at billions of dollars or at a minimum, lots of millions of dollars of liability costs. Yeah. And so that just makes it very difficult to sell an asset to a smaller operator. And you're always on the hook. That sounds terrible. You have a financial responsibility based on your lease with the government, the state, whoever it is. So it's a challenge. It's a huge challenge.
Mm-hmm. You could argue that then the majors are assuming the risk by doing a deal with a private equity backed firm.
Yes.
And so they're willing, because the regulation says you're only responsible for what you drilled on the chain of title. Well, then that last PE-backed firm might only be responsible for the last 8 wells.
Right.
And so the major, who hasn't been on the lease since the 90s, well, they could have gotten on the lease again to prevent anyone else coming on. So anyway, there's a lot of back and forth on this. And when I was at Department of Interior, it was sort of like you have a meeting with the majors and you're sympathetic, and then you have a meeting with the private equity and you feel sympathetic, and it's back and forth and back and forth. And I'm sure the energy workforce technology folks, at least when it was PISA back in the day, an old lady, so I would remember that. But yeah, I mean, this is the whole financial assurance rule regime. That's sort of the constant regulatory drama, is who pays. So I don't know if Tim has a comment also on sort of, that liability back and forth.
Yeah, I don't, that's not my expertise. So I think you hit it well. I don't want to add anything to that.
Excellent. Thank you. And we'll take,
Mark, we lost you.
Awesome.
thanks, folks. Well, Nancy's last question, can anyone expand on the escrowing of liability on these assets? Hello?
Yeah, we hear you. Nobody's answering.
Okay, great.
Deanna, that sounds like that might be a question for you.
Well, I mean, from a balance sheet perspective, you kind of book your liability at the time of the acquisition, and that adjusts depending on, the costs and supply chain, and is it costing us more to plug a well today than it did yesterday? And you're always constantly adjusting that on your P&L. So it just becomes more of an equation of your financials, whether or not you're actually putting the money or escrowing that money. That's another question. I guess it just depends on the company, whether or not they're really setting that financial capability aside and how levered they are.
Okay, perfect. Then there's a question in the chat for Marcella regarding CCS.
Okay, so the CCS and direct air capture are tools that can facilitate the energy transition and reduce global emissions. The BBB Act is dead. Is there a future for carbon capture? So yeah, that dovetails into the conversation earlier that there is a future for carbon capture, but it's not going to be inexpensive. There's regulatory hurdles, there's legal hurdles, and then there's just the cost. And that's something that, is sort of, we don't hear a lot about that because, it's the devil's in the details and it's the numbers. And if you're like me, you'll do anything to avoid a calculator. And so you just don't want to have to think about that. But the cost of direct air capture is very expensive. And so or any kind of carbon capture. So basically, I don't think there's going to be anything significant that'll happen with carbon capture projects until there are significant subsidies. And so we have a lot of companies, and you see headlines all the time in the Houston Business Journal or wherever, where a company's committed to do X with carbon capture. There are zero headlines, really, that are saying, here's what they're actually going to do and where that funding commitment is going to go. And so there are some companies, I know we have someone on the call right now who's at Oxy, and Oxy's done an amazing job with carbon capture. I've been to the carbon capture facility. I flew to Midland. I'm trying to remember what little town outside of Midland the facility was in, and I toured it, and it was super cool to see sort of, here's the nodding donkey, and here's where that gas is going, and here's the plant that's turning that carbon and re-injecting, and then here's the plant over there where the gas is coming out, and it's just amazing to see the carbon capture in action. That's a CCUS plant. And so, but that's super expensive, and so unless you're like Oxy, you probably can't afford to do that. And so how much exactly does it cost? There's some numbers I have. The direct air capture is about $200 a ton. And those, are cost estimates. And so that can be for natural gas, geothermal, or nuclear energy sources. And so I'm also seeing, let me look at my notes here, but $50 to $60 a ton for CCUS for power plants. But those numbers I don't think are accurate. It's closer to $100 a ton. And the National Energy Technology Laboratory is doing a lot of reporting on that and doing cost comparisons I've been looking at. And so those are closer to the $100. Sask Power built the Boundary Dam project in 2011, and they spent $1.4 billion in CCS capital to create a 110 megawatt clean coal plant. And so assuming emissions factors and 10% rate of return, a 30-year life cycle, the cost of capture there was $153 a ton. At a 5% discount, that's $93 a ton. So that's, again, about $100. The Southern Company abandoned a really big capture project. It was such a challenge that there's a whole Wikipedia page dedicated to it. And so this stuff is not inexpensive, and it can be dangerous, and there's a lot of environmental issues that go into it and regulatory. And so without significant subsidies, I don't think we're going to see significant projects.
Excellent. Thank you so much. And we're coming up to a close. So we'll start with Marcella. If you give us like a 30-second brief overview on, what you see as the, current state. Then we'll go Deanna, Tim, and Jesse, and we can close out our session here. So once again, thank you to our speakers, and also thank you to the Houston Geological Society. So Marcella, provide us with a brief summary, then Deanna, Tim, and Jesse. Thank you.
Well, thank you so much for joining us. I'm like so impressed. We have such a big group of people on a Monday, on Easter Monday. On 7:30. So it's awesome. And I'm surprised we don't hear more sort of screaming children in the background during bath time, but that it just might be my kids in the background. So it's awesome that you guys are here. And I think geologists have a really cool job. And it's really funny, in the government, no one really wanted to listen to the geologists. And so now that I'm back into the private sector, I'm always curious to ask my clients, what did the geologists say about that? Because that actually has a really big effect on things, as y'all know. So so thanks for having me. And as far as my take on regulatory high level, to the extent everything I'm saying is like, oh, it's just going to get more expensive. Well, nothing's changed really. I have a sense that whoever has my role on any panel in the foreseeable future for the next century, if you're the regulatory person on an oil and gas panel, you're going to be talking about more regulation, and you're going to be talking about more expense. And that's not just because the energy industry has a target on its back, because it does. It's because the energy industry makes money, and the government, taxes things that make money. And so they do that through regulation. And so, it's just always going to be the way that we see regulation and that we see litigation. So nothing new under the sun. And I'm sorry I have to always be the Debbie Downer. But you can always quantify those risks into your deals and work with people like Deanna to get those deals done. And you can always work with, all the Tims and the Chris's and the Jessies, and get your economics and your your regulations down, so you can at least factor and quantify the price of those risks into your deal. So, so thank you for having me. And I hope that everyone had a wonderful Easter.
Marcella, that combination of geoscience, engineering, commercial, legal, and regulatory, you got to have it all. None of it's a standalone. And if you try to do it standalone, you're not going to make any money.
And thank you so much, Marcella. Deanna, if you can provide us with a brief summary. Thank you so much for joining us.
Sure. Thank you for having me. And yeah, I found this to be a really helpful session, and learned a lot myself, and appreciate everybody's contributions here tonight. As far as just kind of the contract compliance issue in general, I mean, that hasn't changed I don't think for a very long time we've always had contract issues, and we're always, I think, going to have them. But when it comes to, being on the management side, if you can really look at that collaboration of bring in your accountants to the table and talking to them, and also the geologists, the engineers, everybody coming to the table and understanding how they're impacting each other, the landman. I think that always brings a little bit of a better perspective than one going at it versus another. So the panel tonight was, I think, helpful in that regard as well. And I appreciate the opportunity. Thanks, Mark.
And thank you for joining us. I know everyone's got really busy schedules. It's almost been a nightmare getting everyone together, but that's what I live for. So, Tim.
Thanks, Mark. We just appreciate the invitation. It's a great discussion. I think the industry, has gone through a tough couple of years, but we're all working together. We're all on the same team, and I certainly am bullish on the industry and looking forward to the future. So great discussion tonight.
Thank you so much, Tim. And last but definitely not least, Jesse, your I don't know what you call it, race horse thing that you did at the beginning.
Oh,
amusing. If you want to end like that, go ahead.
No. Thank you for including me. This is the insights that we got from Marcella, Deanna, and Tim are very helpful to me in terms of thinking about, just what are people trying to do to even navigate this world. I see a lot of data, but there's a lot of stuff between the real world and the data that is opaque and mezzanine and hard for me to understand. I'm in the business of projections, and if there are any Monty Python fans out there who get this joke, I've got even odds on a Spanish Inquisition at this point in the next 2 years. So there's a lot of unexpected things going on. I see 2 people nodding. Okay, at least 2 people got it. But it's very hard to know. We've got not just the regulatory side of the domestic oil and gas sector. What in the world is happening in the geopolitical space? If this thing with Russia is long-term, do we now live in a world where a substantial portion of global commodities are not traded in dollars? What does that mean for us economically? What does that mean for the US dollar? And so far, nobody's willing to really give that much credence, but it's something that you have to think about in terms of longer term. Lordo's the oil and gas sector. I do think that we're going to see production growth. I do think we're going to see some good years ahead for the industry domestically, and job growth and spending by the sector. I don't think that the capacity is there to really see the kind of drill baby drill that we've seen in prior price cycles right away. I do think we're going to see a bit more of a production response in 2023 as the industry kind of works through some of its current constraints. But there's a lot of challenges, and Tim, Marcella, Deanna brought up a lot of them. Not just regulatory side, labor force, people leaving. You've got a lot of uncertainty. We were having a conversation earlier today about how can the industry guarantee, Marcella's comments about long-term uncertainty and like lack of clarity and how that's impacting long-term big capital projects. How can you guarantee security of supply if you're actively with one hand, while simultaneously the other hand, we're telling everyone that you're working against certainty of demand, certainty of consumption? You can't. No one's going to build a new refinery. No one's going to build a new chemical plant if they're telling them that, well, we're going to do everything we can to make sure no one wants to buy that product 10 years from now. So there's a lot of things that we're going to have to work through in this situation, and I think we're due for a lot of volatility. And relative to what otherwise would have happened, which again, hard to say, but relative to what otherwise would have happened, this convoluted process of internalizing the externality of carbon emissions into the global economy is going to make energy costs higher. And it's not clear how this all pans out, but I think higher prices than we otherwise would have had, and higher volatility, certainly the next several years, is something we're all going to have to navigate. And I highly recommend, based off the comments here, talking to all of the other panelists here in terms of actually figuring out how to navigate that with your businesses. This was an excellent panel, and I appreciate you all having me today. And I'm glad no one asked me about interest rates. Time's up.
That was a good one. Okay, well, thank you once again, and for more events that we have with HGS, please visit the HGS website. I want to thank Patty on the end, who's been a driving force within the HGS, and really appreciate her having on board and kind of helping to formalize this event. And we think that we'll host this as a annual event going forward for the HGS. Superb. Well, ladies and gentlemen, I am on my way to a conference. So I'm gonna say.
And Jordan Alvarez just hit a 450-foot home run. It is opening night in Houston.
Very good.
Super. Well, thank you for joining us, folks.